Okay. All right. And just one more thing we can do here. Sorry, jumping around here. Whenever for submitting any work, if you just do it in Blackboard, I'll get it. So you don't need to email it to me. Also, just you just submit it in Blackboard. So anything that we do, just submit it in Blackboard. If it's not on here, then it doesn't need to be submitted. We'll finish this one up today. Probably both these today. Should. All right. So let's see here. Let's go to. Oh. All right. So this is E6, E3-6, and I modified it. It's a little bit different. It's very similar to what we did. Okay. So let's see, we have these additional notes here. I'll tell you what, let's go ahead and do the let's do the stuff that's kind of a different up here first. Okay. All right, so notes receivable, along with any interest due, are due on November 22nd, 2028. Now be careful with this one because notice that these are notes receivable. Why is that so big? Give me 1 second. Okay. If they're receivable, what kind of an account are they? What are all receivables? Anyone?
The assets?
Yeah, these are the assets. So we're talking about these notes receivable down here. Now they're due on. Oh, someone already did it. I'm sorry. So the receivables, these are when someone owes us. And they're due on, it's kind of a funny way to say they're due. We're not paying these, but these are notes receivable. They're due on November 22nd. So that's the D's. Are they going to be long-term or short-term? Now this is kind of funny too. We're on 2027. So these are going into November 22nd, 2028. So will those be current or long-term? Current is less than a year or less, and long-term is over a year. Will those be short-term or long-term?
Will they be short term?
Less than a year. So I'm just gonna put that note by it here. Notes receivable, these are going to be current. And again, that is kind of a funny way to write it that they're due because it sounds like we have to owe them, but it's not. Okay. Notes payable are due in 2031. That one. Notes payable. Now payables are going to be what? liabilities. Short term or long term?
Long term.
Yep. 4 years or whatever. So let's go down to notes payable. So these will be long termers. They like to call them non-current. Liabilities. Just marking these so you know we already did them. Okay, blah blah blah. Investment in debt securities, so treasury bills, all of which mature in 2030. Okay, current asset or non-current asset? Investments,
Non-current,
long-term, yep. All right, so let's see, what was that? Investments? Okay, so these will be in the investments account, long-term, non-current. Do I call it non-current or what do I call it? I can't remember. Usually just call it investments, just investments, okay. All right, and deferred revenue will be recognized equally over the next 2 years. Deferred revenue is a liability. And it's going to be recognized equally over the next 2 years. Current liability, non-current, or both? So next year we're gonna recognize some, and the year after we're gonna recognize the other half of it. No, the year after the other half. Did I say that right? Equally. All right. Half C's. So there's gonna be a liability. Both. Yep. Great. Yeah. So we're gonna do is the half will be liability. So it'll be current 16. I'm gonna abbreviate. Okay. And non-current 16K. And we can always go back and look at it if we don't know what my hieroglyphics mean here. Maybe I can fit it in. Yeah, okay. So current 16,000, not, wait, that's not right. It's not 16,000, it's 36, so half of 36 is 18, right? I'm sorry. Ignore what that knucklehead is putting in. 18 plus 18 is 36. Actually, I can just space this out a little, write it down. Okay. That's it for those, right? Okay. All right. Now I'm going to go over a single step income statement. Single step income statement just has, it's basically just money coming in versus money going out. It doesn't have those extra steps in there for cost of goods sold and that sort of thing. We're going to talk about this more later on in the course, but single step income statement. And you might be wondering, well, why are they allowed to do that? You know, this is revenues and this is just money coming in, and this is money going out. It's a little more complex than that, but that's basically what they're doing here. And so, say, well, why don't they just make it a multi-step like they're supposed to? And a lot of times you'll see companies, if they have consolidated financial statements, they have a whole bunch of different companies. They may be very different in what they do. They may have maybe they manufacture something. Maybe they have investments in the financial market, financial industry. Maybe they have investments in entertainment. Maybe they have all these other things. And a lot of times, a multi-step income statement, if you combine all of those, it doesn't really make sense because you're combining making movies, making cars, and making and financing, and maybe an insurance company thrown in there just for fun. Making it into a multi-step just doesn't do anything for you because it's not really, it's no one industry. So sometimes they'll just do that. And if you want to see how each of those is doing, they'll have a separate financial statements for each of those. So how this works is if they have over 50% of a company, they will have their own financial statements. They'll have all these other financial statements. Those will all be published, and they'll have a consolidated. And that consolidated statement sometimes will be a single step because they're all different. We're just going to do it just to make it a little quicker. Okay, so let's come down here. So revenues. We have two revenues. We have sales revenue and interest revenue. I'm going to copy those. The amounts. Oops. And I'm just going to call this total revenues. I'm gonna label these columns. I think I did it on the document once, but I didn't do it on this one. These will be the totals.
Professor, do you have your screen mirroring on? I don't know if it's just me, but I can't see your screen.
I don't. I'm an idiot. Thank you. We can't. Thank you. I'm sorry. Well, that whole part of the class was just for me. Did you guys see any of this? No.
No.
Darn it. All right, let's go back. We'll go back. I hate when I do stupid things. I hate it. All right. So first one was notes receivable, current asset, the whole 100,000. The notes payable, and here. No, it wasn't. It was down here. The 400,000. The notes payable. Those are all non-current. Investment and debt securities and T-bills are due 2030. I'll back up here in a second so you didn't think. And then the deferred revenue. And I sincerely apologize. E2. So this is taking care of those. The four odd things that are out there. Thank you for alerting me. I would say it's because I'm getting old, but I've actually been doing this my whole life. All right. But getting old might have something. All right, so I'm going to get the total revenue here. This is 803,000. Okay, so this is money coming in. And now we're gonna compare that to the money going out. Let's see. So cost of goods sold, all the way down to income tax expense. Usually they break out income tax expense separately. We're just gonna leave it together. Maybe I'll. Okay. Hey, how come those don't match up? Oh, except for the first month's. All right. And these are money going out. I'm gonna go ahead and put negatives for all of these. You can actually do that with the pasting. And the reason I'm doing this is just to show that this is either money or goods going out. Okay. And all goes up. So these are the total expenses. And again, this is a single step. And let's make those orange. And so this will give us our net income. That can't be right. World.
Shouldn't it be 302,000?
Yes, it should. You know, wacky. Okay. New plan. We're just gonna add them together. Okay. What is that weird? All right, well, sure what happened there, but regardless. Okay, so this is income statement. And again, the single step is just what comes in. Actually, this is, everything on the income statement basically is what comes in versus what goes out. Even the multi-step and all that, it's all exactly the same. It's what came in, what went out. We still put the multi-step puts it in different categories, but the idea is exactly the same. What came in, what went out. That's all the income statement is, and hopefully, what came in is more than what went out. Okay. Let's go to the statement of retained earnings. Do we have any retained earnings? We do. Okay, so our retained earnings are 150,000. So we'll start out with our beginning retained earnings of 100,000. Retained earnings. $50,000. We add in our net income, the correct net income, not the income I had, the correct net income. We subtract out our dividends. And we do have, I don't think there's no scam. I gotta go find our dividends. Here it is. So our dividends are 6,000. Why does this thing seem wide? So our dividends are 6,000. So that's gonna be negative. And here. And so this will give us our ending. Put it anywhere. I'll put it up here, guys. Ending retained earnings. See if this works. $452 minus 6. Hey, it worked. All right. Yeah, let's make that turquoise. Okay. And this is the owner's piggy bank. So, this is what they have in the piggy bank. What, 452. They took out 6. They have 446 left in the piggy bank. And you'll notice that 446 that's left in retained earnings. So this is earnings that they haven't paid out yet. You'll notice that's not all in cash or anything like that. It's reinvested in the company. The cash here is only, well, there's two cashes here. It's 20 and 80,000. But anyway, it's not all in cash. Point being is, even if they wanted to, they couldn't take out all 400. They have to get more cash somewhere. You can pay it out because it's reinvested in the company. Okay, let's go to what we really came here for. That's the balance sheet. That's not balance sheet. All right. Let's take a look here. Restricted cash. Payment of notes payable. Okay, this goes back to notes payable. This notes payable is long term. I'm going to change the color so that we know it's different. Oops, no, I don't want to do that. Here. And let's make it kind of orange. Okay. And I'm going to change it down here to reddish too, just so we know these are all together. Okay, so this restricted cash payment for notes payable. That's for these notes payable. Sometimes it's by the document itself that they have to set money aside. You know, the note payable will say you have to set aside a certain amount. Sometimes management will just do it. They say, look, we got this notes payable coming up. It's 400,000. It's due in whatever 3-4 years or whatever. We have to start setting money aside for it. We can't spend that cash. That cash is gonna be used for, you know, paying off this notes payable. So notice that this cash restricted for notes payable, this is going to be non-current. This is gonna be long-term. This is gonna go with the other assets. So I'm gonna go ahead and put that in right now so I don't forget. So restricted cash. 80,000. All right, going down here to our assets. It's not in current because we're just using that. We're not going to use it for 4 years. It's not an investment. We're not really making money in this thing. It's not property. Tangible. Comes out here as this. And that one. How much was it? 80? 80,000. I don't know if that's the only one we have there or not. I'm gonna put it here for now. If it is the only one, we'll move it over. Okay, let's go and do the cash. Cash is 20,000. That's current. Maybe a better way for me to do this. I can freeze the screens. No, no, he's gonna screw it up. Don't freeze the screens. You're gonna mess it up. Oh, I see why. Try this again. Oh, I get it. All right, well, all right, accounts receivable. And allowance for uncollectible accounts. We'll copy those both down together. You go together. All right, allowance for uncollectible. So it would be negative 13,000. So this will be our net accounts receivable. You know what? I just realized I should be doing this over here. All right. So let's be the accounts receivable. $17. Okay. Notes receivable, current asset. I think the rest of these we can copy. Oh, wait, prepaid rent. Oh, we gotta do something with that one. Well, I'll copy the easy ones down and then we'll look at that prepaid rent. Notes receivable current, interest receivable will be current, inventory will be current.
Professor, why is the cash like credited 20,000?
Yeah, these are just the totals. These aren't debits or credits.
Okay.
This is the way you usually see them. I toss and turn thinking about this. A lot of times you'll see though, like things like this, where they have to do calculations, you'll see them offset. If you put them all in the same column, that's absolutely fine. If you do this,
Wouldn't the net account would be 137 though, right? Because you have to add the 20,000 to the 130, so 150 and then minus 13,000, which would be 137.
the accounts receivable. Oh, for the cash, you mean? The cash on, yeah, we're gonna add all these up in a little bit. If you don't put these all in the same column, that's fine. When you add them up, though, be careful that you don't add these in twice. You know what I mean? You can't just do a sum if you put this over there. So this will be. Should have left more room for this one. We have to move the investments down. Okay, I made this right. So gross receivable, interest receivable, inventory. Oh, I know it. Okay, wait, prepaid rent. Okay, so this prepaid rent, this is a problem. Why? Is a prepaid rent here going to be a little bit of a problem? What's the problem with putting all that into current assets?
One's gonna be short term, one's gonna be long term.
So this will be. Yep, good, absolutely. So we have to split it in half, so. Yeah. So one half will be current and one half will be other. Okay, I'm just gonna copy the name just to, so prepaid rent. One half of that is 30,000. And I'm gonna copy this down to other. Oops. So let me make sure I did that right. 60,000, half of it is current. And half of it is non-current. And it's not really an investment. Investments are usually something that makes you money. So these are not gonna, it's not gonna be an investment. You don't really make money on the prepaid rent. You probably paid it in advance, probably you had some kind of a deal on it. Okay, let's go back up here. Investment in debt securities. Investments, that's all long term. I'm gonna go check and make sure I did that right. Investment in debt securities goes on 23. Okay, that is right. Okay, so investment in debt securities 32. This is gonna be in the investments account because it is non-current or long term. So yeah, and by the way, everything underneath here is non-current or long term. I'm old, so I still talk about it as long term, but the you know the correct terminology is non-current. And I think they changed it to that just because, you know, from here on down, these are all non-current. And I think they just did that because long term has a connotation that, oh, this is for 5, 10 years, where it might just be for 15 months. So everything down here is actually non-current. The only thing that's current is up here. Take that, no, close. This doesn't matter. Okay. Okay, so I'm gonna make sure that we do that. I'll make sure that I've everything we've done here. Just okay, so we're done. Okay, right. So let's go ahead and go to property, plant, and equipment. Okay. So property, plant, and equipment, land, buildings, equipment. I do something. Okay, so our accumulated depreciation for the buildings was 620 something, I mean, 620 and 130 were the depreciations. And just because I'm paranoid, I'm gonna go back and check and make sure that that is what. 620, 130, okay. Okay, so our net buildings will be $680. So, these are all the buildings, so we're gonna say that we paid 1.3 million, 620 been depreciated, so there's 680, so these are about halfway depreciated, it looks like. And we do the same thing for the equipment. And a little less than half depreciated. We'll add these up later, we'll get to them. Oh, I think we're almost done with the assets, right? Last of the asset. Pat, where does that go? Anyone? Where does Pat go?
The intangible.
Okay, I'm gonna get totals for all these. Okay, so I'm gonna put the. So this will be our total property, plant, and equipment. Oh my. Hope some works. 170 plus 680 is what, 750, 850. Okay, it did work. Yay. Let's make that. Which we make these all. It's a little bit harsh, maybe. Whoa. Okay, we'll make the totals purple. Okay, I'm gonna move the investments down one purple. So our total current assets. $25. 40. I think that's it. Investments account, there's only one of them. I put up. Had the same thing. I'm gonna add up all the purple ones here. Total other. Total up all of them. So this will be. You want to check that. Actually, I might want to check my number. By the way, if you go into auditing, some people are surprised that they usually use spreadsheets. They'll even they'll have register tapes to go with them. They'll do it by hand also because they don't want to make a mistake there. And well, like you saw, like with that they have here, this, you get the wrong number. If you just believe it, you get in trouble. And when you're doing audits, you don't want to do that. Basically, when you're doing auditing, you're preparing to go into court. If you get sued, what do you do? And so you need to have all your numbers correct before you do that. Okay. Oh, we got the assets done. Man, is that a lot of work? Okay, let's go to liability. Okay. Next thing is there's usually less. Okay, so let's take a look here. It looks like well, let's do all the I think we do all the non-current at the same time. The deferred revenue is gonna be half current, half non-current. So we'll just do it once. Actually, we just copy the whole thing or just change the line. I'm gonna teach you guys how to be lazy, like me. All those get copied over. We have to do a little bit of an adjustment here. Oops, current. So this will be the current portion. I think that's it. Take a look at this again. Gotta pay our taxes next year. We gotta pay deferred revenue. We're gonna earn half that this next year. Well, okay. And we have these non-current liabilities. So we're gonna have deferred revenue. Let's do the deferred revenue first so I don't get confused. So we're gonna have deferred revenue, current, and this will be non-current. Splitting it up. Stop doing my X's. I should keep going with it. Okay, X, X, X. We got those X. And now let's do this note payable non-current. Equity. We're doing it incorrectly. You guys tell me where I'm wrong. Equity has common stock and retained earnings. I put this in incorrectly. Just because that's the way I do things. What did I do incorrectly? It's a wrong number in the equity section. Anyone?
Would you have to put the ending retained earnings in instead of like just the regular retained?
Yep. Very good. That did not work. Let's try that again. Okay, much better. So this ending retained earnings, this if your balance sheet doesn't balance, that's a good one to look at because it's often even myself done a million of these. Now and then I'll look at it. Why is this balance? Okay, you can actually see. So you gotta take this retained. You take the retained earnings. Ending retained. Put it down here because this is what's in their piggy bank now. Okay, let's add all these. So this will be the total current liabilities. Correct my numbers. 38, 43. Yep, that looks like it's okay. We'll do that. Maybe those purple will be. And we'll have total non-current liabilities. 418. And our total, or any retained earnings, total ending retained, or total equity. Now you see it total shareholders equity or total stockholders equity, same thing. Let's call it total equity. Okay, now hopefully those three things. Okay. Plus that, plus that. Some crazy number, yay, it balances. And again, if they don't balance, check the retained earnings. Oh wait, I didn't check off all. Okay. What's something? Okay, let's take a break and be back at. Leave this up. Three oh one till 311. So this is really what we're going to focus on for the exam. Will be on the classified balance sheet. This is kind of up there to show how it still is part of our financial statements. Okay. Okay, let's go ahead and get started on problem 3.3. This will be similar to what's on, will be on the test. This will be similar to the test. Classified balance sheet. And okay, let's go ahead. These. We'll do the same way we did before. Let's start with these. Start with the difficult parts. Okay, the investment in equity account includes investment in common stock of another company of $30,000, which management intends to hold for at least 3 years. Okay, so 30,000 is long-term or non-current, I should say. The balance of these is intended to be sold in the coming year. Okay, so that'll be current. Okay, so 30,000 is long-term. So let's go down to this account, investments. I'm just gonna add a line. Okay, so we're gonna say that it is 30,000. I'll check this number again. 30,000 is investments, I should say. So investments 30,000. So the rest of it would be what, 80,000? Yeah, so current. What's that one? Land. Includes land which costs 25,000 and the company has not used and is currently listed for sale. Land. So it's 90,000. What are we gonna do with that one? Anyone?
Would they just be using 75,000 of it and then like non-current would be 25,000?
Yes. Well, yeah, so the let's see. So in the investment, it would be, yeah, okay, yeah, so land would be let's see here. Probably plant and equipment would be whatever is left over, 25, that 90, like that 60, like 65,000. And then we'll have an investment. Oops. Is 25,000. So the land that we're using will just be in property, plant, and equipment. The stuff we're not using that we're holding to sell will be in a investment account, and that's not how you spell investment. In case you're wondering. Doesn't start out with two I's. They're right. Yeah. Okay. So land, we're splitting it up. Investment and probably plant and equipment for what we're using. The cash account includes $15,000 restricted for a fund to pay bonds payable that mature in 2030. And 23,000 restricted in a 3-month treasury bill. Okay, so we have two restrictions here. One is long-term and one is 3-month treasury bill to be current. All right, let me. So this is actually, there's actually two things that are come out of here. So we're gonna have, well, three things really. I'll make this one for color because this is confusing. Okay, cash. Cash account has includes 15,000 restricted pay bonds payable that mature in 2030, excuse me. I think this is this post closing balance. I didn't put a date on here. Let's put a date on here. 12/31/2027. So 2030 is gonna be long term. Okay, so let's see here. So cash. So cash will be restricted. 15,000. And that will be an other. We'll have restricted. 23,000. Again, 23,000. Current. And then we'll just have cash of whatever the rest is. So 45,000. Don't have any cash left. Okay, so 45,000 minus 7,000. And so cash and cash equivalents, by the way, are they include cash, money market, treasury bills up to 90 days, and also commercial paper. You guys probably know, and I'm sure you know what cash is. Money market is just kind of a savings account. Treasury bills are just government bills that you can actually buy and sell in 10 minutes. Commercial paper is one that maybe you're not familiar with. Talk a little bit about what commercial paper is. Commercial paper is only, it froze there. Commercial paper is only available for long, or for large companies usually. Commercial paper is very short-term loans. These are loans that will be paid off within days or possibly even a week or so, but they're very short-term. And what they are is large companies, when they need cash to make up a daily, for their daily cash needs sometimes, they will get that cash by this commercial paper. Commercial paper is very low interest, very low risk, short-term, very short-term loans that are used for large companies to kind of shore up their cashes for their cash account for the day. And usually large banks are the ones that deal on this. And again, they're very low interest. They're very low risk because they paid off usually within days. And what they are is, it's when companies need to get cash. Let's say they need to raise cash for whatever it is. It isn't that they're not profitable. This is very short-term stuff. So if they need cash to make the payroll or to make make their accounts payable or whatever it is, they'll go and get this commercial paper, and it's literally is a few days, and it's usually done for timing. And the thing is, people say, well, why don't they just sell securities or something like that? Well, you run into transaction costs. And a lot of times those transaction costs of selling, securities or whatever to raise the cash, even though they have the securities, a lot of times those transaction costs are more than the interest. So you'd be better off just to pay this very low interest, which is usually a fraction of a percent, rather than taking those hits for selling commissions and all that kind of stuff for selling stocks. So that's what this is. It's again, only very large companies do it. It's a very active market. It happens daily. You'll have bank one will have hundreds of millions, if not billions, tied up in this for at any given time. Very low risk. It's just kind of free money for the banks a little bit. And it's also good for the business, for the companies, because they don't have to incur larger expenses to shore up these short-term shortages. So that's what commercial paper is. You don't usually see it in a small company. Like this would be a very small company that actually issue commercial paper. There's no they actually would, but just so you know, that's what. Okay, so did we get that one? Are we done? No, we're not done. Not even close to done. Okay, notes payable. Notes payable consists of the following: 30,000 is due in 6 months. 50,000 is due in 6 years. Okay, those are pretty easy. 50,000 is due in 5 annual payments of 10,000 each. Okay, so that means 10,000 is going to be current of that, and 40,000 is going to be current. I'm going to wait and do this. When we come to these notes payable, we'll do a little simple. Okay. In common stock, I think this is just a represents 100,000 shares of no par value common stock issued and outstanding. The corporation has 50,000 authorized. We'll wait on that too. So that's an easy one. This one's easy. This one's hard, and those two we've already done. Okay, let's go ahead. Okay, so our cash and cash equivalents, we're going to have just the plain old 7,000. Put it over here. We have restricted.
Sir, wouldn't
Yeah.
the cash and cash equivalent also include the restricted cash of 23,000 for the treasury bill, the 3-month treasury bill?
Because it's restricted, it actually it would be if it wasn't restricted. If it wasn't restricted, it would definitely be in cash.
Got it. Thank you.
Yep. Yeah, you know, that's good. That's an excellent question. I didn't think about that, but yes, that's absolutely true. If that treasury bill was not restricted, it would be in cash and cash equivalents. Absolutely. So it'd be 30,000 in them if it was not restricted. Okay, so restricted. So cash restricted for the current is 23,000. And I'm gonna put cash restricted current on here, just so we know what that is. I mean, it's in the current assets. We probably know that anyways, but you know, yeah. Okay, I'm gonna go ahead and take care of that other one, the restricted other. Decide I don't want to forget it. I'm going to. Oh, too much. Do the old. Let's put an X by things that we're doing now. So let's go ahead and take care of that restricted other. That'll come all the way down here to other. We'll have cash restricted. $15,000. You return in 2030. Maybe you might put 2030 in there if you want. Cash restricted. I put that in there just so people reading it know where he is, and it is. Is that right? 30, 845. Yeah, that's it. Okay. Okay. So let's go to investments in equity securities. Investments are 30 and current assets are 80. Okay, I'm gonna do current assets first. You probably don't need to put current. We're in the current. So a little bit redundant, but and I'm going to go ahead and do the investments while we're at it. I don't know if it's our only investment. It's not our only investment. About 80,000 it's 30. Yeah. Okay, so investments current 30,000. Checking to make sure I didn't. Okay, 80,000 is current. This isn't current. This is investments. Non-current. Okay. Accounts receivable and allowance for uncollectible accounts. By the way, this is the one it was one I changed from the book. They kind of had it written in kind of a wacky way. Net accounts receivable. So allowance for uncollectible accounts. We don't know who is not going to be able to pay that, but somebody will. I'm going to put that in as a negative. Oops, not a negative plus, a negative. Okay. Hand act. All right, so this is. Yeah. So we're going to tell the reader, look, we don't know who's going to go bad, but somebody's likely to go bad. We don't think we're going to collect 68. We're only going to collect 60. Now we have 68 on the books because as of now, some people owe us, but we know that we don't know who it is, but somebody's not going to go bad. Okay, let's get stuff out. Inventory. And prepaid insurance for the next 9 months. Those all look like we want them to look. Inventory is always going to be a current asset. And probably, I'm sorry, prepaid is, as long as it's within the next year, it's going to be. Make sure I did this right so far. Okay. All right. Now for the fun one. Land. One of the fun ones. So 25,000 is going to be an investment. 25,000 is currently listed for sale. It's not in use. Okay, so this will be land. For sale. In use. It's 30,000 awesome. Not odd, they're both the same. Here's a test you say, oh, anything is 30,000, that's an investment. All right, and the rest of that land just goes for land that's in use, 65,000.
Wouldn't the land for sale be 25,000 in the investment?
Yes, thank you. Thank you, thank you. It's not 30,000. What was I talking about? Saying wacky things. Right, wacky. Okay, you're absolutely right. It is. So this be 65,000. Is it oops in use? Yeah, yes, it is. Thank you. So it is. I'm putting in crazy things. Okay, so our land. And by the way, all this property, plant, and equipment, these all have to be in use. And the reason I say that is if you get a piece of equipment in at like the end of the year that you're not using yet, it doesn't go in property, plant, and equipment. And it doesn't get depreciated until you start using it. And so, for example, if you get some equipment in on December 28th, and you're not gonna start using it till the next year, you actually don't put it on the books as property, plant, and equipment. It goes in as other assets. Start using it, and then you start depreciating it, and then it goes to property, plant, and equipment. Okay. Buildings, accumulated depreciation, and equipment accumulated depreciation. I'm gonna give myself a little bit of room here because I think I got enough. All right, so let's see, buildings. Accumulated depreciation. Equipment. Depreciation. Net buildings. $320, that looks correct. Focus be net equipment. And I'm gonna do something up here. I'm gonna say that's 65,000. Rid of that one. That's the total. So this is the total for the buildings, or the net for the building is say this is the net for the equipment. I think that's it. Let's check these off. You go. Pen. Where does that go?
Intangible.
Pens are intangibles. That's only what we have. Okay, I think we're done with the assets. Check and make sure. Yep, all those are good things. By the way, this retained earnings, say, well, wait a minute, is that beginning retained earnings? If this is the post-closing trial balance, that's the ending retained. So everything gets closed into that retained earnings. All right, let's start adding. So, okay, so add up all these, your total current assets. Great number to me. Make that. Please make it turquoise system. Other current assets. Okay, total investments. They'd probably be over here again. Big number. That turquoise. Total property, plant, and equipment. There should be commas there. There should be a comma before the and equipment. There's actually law cases out there. Hard to believe, but yes, there are. Okay, so this is there was a law in New York that they wrote out the taxing things. One of the things that they tax, you know, tax entertainment, blah, blah, blah. And they said food and drinks without any comma. Well, one of the people reading it said, okay, well, that means you only tax food and drinks for this amount. If it's food, you don't tax it. If it's drinks, you don't tax it. They have to be together on the same bill to tax it. And they won. And rewrite that one. Entertainment tax. Okay, patents are just that. This is just. So let's see, total current assets equals. $894. All right, let's jump to the other side and see if we can get that same amount. You know what I'm gonna do? I'm gonna hide the assets for now. Less dangerous. I'll probably lose them, but okay, let's just go liabilities. All right, let's do the easy liabilities first. Accounts payable looks easy. Interest payable looks easy. We'll do those first. Accounts payable. Interest payable, that's easy. Okay, let's go to the terrible, awful, terrible one. The notes payable. For the notes payable, we got to go up to here. Okay, so there's a $30,000 note due in 6 months. Okay, is that current or non-current?
Current.
Current. Okay, so notes payable. That is current, and that was for. Yep. I'll say your it's current. Note payable in 6 years.
That's non-current.
Current. Yep. That was from 50,000. It's once at 6 years. Okay, now for the wacky one. $50,000 note payable on 5 annual installments of 10,000 each. Okay, so next year we're going to pay one of the 10,000. So let's do it on February 15th, 2028, which is a month and a half away. So this will be 10,000 will be the current portion of a long-term notes payable. 40,000. And this will be notes payable and let's say notes payable 5 years. You would actually, in the notes of the financial statement, you'd have installment. Oh, did that wrong. Wrong one. Let's try that again. All right, and so let's see, that would be what, 40,000 is left of that? So at 50,000, this is for C. Tell you what, we should do this. So this is A. Super X's by A's. B is here. This is B. You don't have to do this on the test. I'm just doing it so. And this is C. And all those should add it up to 130. And they do. All right. Let's see. Bonds payable. Bonds payable are virtually always going to be long term. Bonds payable are similar to like a mortgages. Unless they tell you that it's due. Current will be long term. Here's a question for you. When do long-term debts get paid? Never. Because they get switched into current. They'll get reclassified. So when if those bonds payable after due in 10 years, at 9 years from now, those are going to flip into the current payables, current liabilities, and because they will be paid following year. So the trick question is, when do long-term liabilities get paid? Never. You have to turn into current ones usually before they get paid. Okay, common stock and retained earnings. And again, this is post-closing, so these are actually the ending retained earnings. These are already the ending. Everything's been closed into this account. Why you put this? I'm kind of generous here with the. So I'm gonna consolidate this a little. Kind of get it on the same page anyway. Okay. Sorry about that. Okay, so let's go ahead and total all these up. So this will be total current liabilities. Are all those? Oh. Okay. Total non-current liabilities. I think, I mean, we're close to right. Maybe. Well, equity is. Hey, hey. Oh, I'm an idiot. I'm gonna do some stupid. Give me a second to clean my nose. You now see why I was so terribly wrong. And my apologies. I will never do anything stupid again. I know you have good reason not to believe me, but. Okay, let's try this one more time. Equals that plus. That is not right. That is right. Okay. Hey, later on that same day, I got it ready. All right, so this is what it would look like. So this is what you're gonna be able to have to do on a test. You probably won't break up the notes payable that much. But probably maybe do an installment one. So any questions on that? So we can turn both those. So those last two assignments we can turn in, and I'll be sending out the exam by tomorrow, hopefully by tonight. Any questions? And I know that you guys have sent me some stuff that I need to put in, so I will be doing that. So. Any questions? So on the test, you're just going to give you a classified balance sheet. You have to do it, and just to let you know, like on the CPA exam, they may give you a whole one to do. They may also just give you ask questions of it. You know, for instance, I may say, what are the total current assets? What are the total current liabilities? And if you can do the whole thing, you can do it. You know, you'll be able to do it. So while that may not exactly be the format you'd see on the CPA exam, they may do it multiple choice questions or kind of drop down what we used to call essay questions. They would more calculation kind of questions. They may just ask you for the totals of different accounts. But again, if you do the whole thing, very good. Any questions? Okay, I'm gonna sign off right now because we still have a minute or a minute under. I tried to get this done in 2 hours. No questions? I'll stick around if you have any questions.
Yeah, I had a question for you. Just wanted to make sure it was regarding my submissions. I'm
Yeah.
not sure if you were able to see my other assignments because I submitted them under numbers.
You submit them under what?
Under like on the numbers app through Apple. I took screenshots of the exam.
Yeah.
Yeah,
Oh,
and I sent them to you through email. So I
yeah.
was just curious if you need me to do the same for the other assignments too.
Yes, if you would, and actually, if you would just submit those screenshots in Blackboard.
Uh-huh.
The reason being is like there's grading notes and stuff that I can put in there in Blackboard. So if you do the screenshot, and there's nothing, and just to let you guys know, share my screen, unlike I did earlier. Here, on any of these, I'll pick one. You know, you can submit 10 screenshots. You'll notice that these have unlimited attempts. You can put in 50 attempts if you want. You know, you put in 50 screenshots if you want, and the highest grade is taken. But all of these are you can put in as many as you want, and I like having them in there just because that way the grading notes. You know, if you're emailed to me, you know, if I take off 7 points, you probably want to know why I took off 7 points, and that those can all be put in there. So anyway, yeah, submit all of it if you would through Blackboard, the screen, and screenshots are fine. I don't mind screenshots at all. Just so you know, if you want to keep doing it in numbers instead of the screenshots, that's fine.
All right, yeah, sounds good. Thank you.
Any other questions? Yeah, and again, you know, however you do it, if you do it, you know, some of you might be doing this on notebook paper. That's fine. Just take a picture of the notebook paper. You know, 5 pages of notebook paper. That's fine. Just take a picture of it, send it in. That's it. I did submit it in Blackboard though, because then I can, you know, I can let you know how the grading went, and you can ask me about the grading too. So, questions? Okay, and again, be looking for the exam. It'll definitely be out by tomorrow. I'm gonna try to get it done tonight, but if I don't, it should be done today. Okay, see you guys.